Hello and welcome on this edition of All About Your Company. We're going to be talking about a company which has done 11x in terms of shareholder returns in the last 5 years. So it's been a multi-bagger, and not just that, it's done 60% in a market like this over the last 12 months. We're going to be talking about Gallantt Ispat. In terms of the move today, of course, it's done 15% today itself, but even if I remove today's move, it's still a significant move over the last 12 months that we've seen on the stock price. It's been choppy though over the last 12 months. It's fallen off the highs, but certainly done very, very well if you bought it at the right price. So we'll try and understand what's playing out with regard to a Gallantt Ispat. I'll try to break this down the best I can. What is the reason for the 15% move? First off, there's been very, very strong pellet production that the company has engaged in for the quarter ended Q4. In fact, pellet production was up nearly 59% on a YOY basis. What this will likely do is you'll get earnings which will likely be better in terms of Q4, likely because a lot of the raw material is now sourced in-house as a result of this. But we'll try and break that down, speak with management, get a perspective as to what this means. Second, we'll try and understand what's happening to realizations. Realizations has been that piece which hasn't done as well, but globally steel prices have been very, very robust, and therefore you could well see a sustained kind of a number with regard to realizations. In fact, hot rolled coil, which is HRC, which is the standard which one uses to kind of judge as to how steel is moving, has been pretty stable, at least from an India pricing as well as from a global pricing standpoint. But we'll get a perspective on that. The third piece is cost reduction, therefore, in Q4 as well as overall. What does this do from an FY27 standpoint? We won't speak much about Q4 because company will likely be in silent period. But we'll get a perspective as to what this will lead to going forward. In terms of the 5,000 crore revenue, aspiration that the company has, how quickly do they get there? Really, that's the question. And they will be meeting with analysts. That is, I think, something which really stands out because there's no institutional participation that Gallantt Ispat has, and therefore they're meeting with analysts. Does it signal a bit of a turnaround? What does it mean? Are institutions suddenly interested? It's a 16,000 crore market cap company as of today, and therefore there is room for institutions to participate in the story. We'll try and get a perspective on that as well. Now let me take a step back, try and explain what the company does. The first piece is it was incorporated in 2005. It's a flagship company, Gorakhpur based, and it's part of the Gallantt Group. It manufactures pellets, sponge iron, billets and TMT bars, but essentially it sells only that last piece, which is TMT bars. That's what they are specializing in terms of its sales. All the others are just inputs to achieve that output of TMT bars. That's the way to think of this. And let me explain each of the products very quickly. Pellets are nothing but small balls made of iron dust. A lot of the iron is also sourced in-house from the mines that they have, so all captive, fully backward integrated all the way till source, and it is melted. Pellets are nothing but they are iron dust balls which are used in the manufacturing of steel. These are used completely in-house. The pellet production has gone up by 59% YOY, so very, very strong numbers there. In terms of sponge, that's the second piece of the product line. It's iron that looks like sponge. It has certain pores, and when it is formed by heating, therefore, and what it does is basically it is melted into steel. That's really the chain of production. Again, it is largely used in-house. Now we'll talk about mild steel billets. These are nothing but steel bars which are manufactured and used for various purposes within the steel industry. It can be used, for example, for the purpose of TMT as well, and I'll explain TMT in just a bit. But broadly, they are nothing but steel bars. These are long rectangular steel blocks. They are made of with sponge iron and scrap steel. It's a combination. It's used in factories and is used therefore in steel rods, bars and the like. I spoke about that. Now, TMT bars. These are strong steel bars which are used in the construction industry. Roads, buildings, infra and the like is what TMT bars are used for. This is their main product, right? And Gallantt TMT, which is a further upgrade in terms of the quality, is also something that they are selling now. It's branded TMT bars, nothing but that. Then there are mist TMT as well, where the finished product hasn't come out the way they wanted to, in which case maybe the size is different, maybe the quality is slightly lower, in which case it can be used for a slightly different set of infra build, but nonetheless can be used, and therefore they sell that as well. Electricity is also something that they manufacture, and they manufacture it in-house. The good part about the company is that entirely integrated internally, in the sense that from raw material to finished product, including the electricity, is all internally generated to ensure that the process is fully in-house. That's what really stands out with regard to a Gallantt. In terms of the capacity, they have 1 million tons of capacity for finished steel, and they have a 300-acre land bank as well. So further growth likely in the pipeline. The business model, I think it's now fairly clear, but they manufacture everything in-house, integrated value chain, mines to pellets to sponge to billets to TMT. That's how the process goes. Captive power meets all of the electricity needs. They also own, by the way, the distribution side of things. They own railway sidings and rakes, which are nothing but your railway carriage, which carries all of the steel from one place to another. They own 2 rakes, and 80% of their sales are made through dealers, and 80% of their top line, 80% plus of their top line is TMT. That's broadly the way to think of this. They distribute to 3,000 plus dealers, and they distribute across states. They have presence in Gujarat, UP, Bihar, Delhi, and Maharashtra is also somewhere, is also some of the places, but entirely domestic. They don't cater to the international market at all. Commodity outlook, and I spoke a little bit about this. Domestic trades at around 50,500 per ton currently. Foreign, the rates are currently at $465 a ton. There's a 12% safeguard duty, and therefore largely that foreign to domestic ratio matches, and therefore what you're seeing is domestic prices, at least on the HRC side, which is hot rolled coil side, is fairly stable at this point. Now let me talk about some of the numbers, in terms of the top line itself, it's been very flat, frankly. It's grown at around 12% CAGR over the last 3 years, from 3,000 to 4,000 crore, and when you look at it from FY23, there's been hardly any growth. But essentially the aspiration is, I mentioned this, to get to the 5,000 crore mark. But what's really standing out is the EBITDA and the profitability. That has seen a very, very strong growth, especially in FY25. You've seen very strong growth on EBITDA, profitability also up 32% CAGR over the last 3 years. So that's what is helping the company stand out in terms of growth. EPS growth has been very strong, which is why you've seen the kind of move on the stock price as well. And that is driven largely by margins. You look at the margin number, and this is of course the current year, 27% growth on profit even in the current year. And that is because of backward integration that they are undertaking, costs going down. I'll speak about that when I talk about margins. Let's look at the margins, and what you'll see on the EBITDA margin count is a steady uptick. The aspiration was to get to 13%. They're currently at 17%. We'll try and get a sense as to where we stand in terms of the forward margin trajectory. Let's look at the EBITDA per ton, and what we're seeing is EBITDA per ton last year 9 months versus this year 9 months has gone up from 8,054 to 8,749. While net realizations have come down, what has happened is cost savings, especially on the raw material side, is aiding the EBITDA per ton. So the EBITDA per ton therefore has gone up by nearly 10% on a YOY basis, which is also driving margins higher. When you're looking at the balance sheet, that's the second metric, third metric of course, you're seeing the book value at around 3,105 crore. It's a 15,000 crore plus market cap, and therefore 5 times book is what it trades at. And it has a borrowing of around 657 crore. Let me split this. Only 100 crore of this borrowing is long term, the rest is short term, and their interest cost is sub 50 crore on a trailing 12-month basis. So interest cost really not weighing on the company, which is an asset heavy company, and that's the other thing that kind of stands out. It's a resilient balance sheet, no doubt about that, despite that 5:1 debt, 1:5 debt to equity that we're seeing. We're not seeing a very adverse impact on the P&L as a result of that, and that's something you want to be mindful about. Cash flow, You've seen a decent kind of conversion of EBITDA to operating cash flow, and therefore we've given this one a thumbs up. Return ratios have been healthy, especially in recent years, but have been choppy overall. And therefore, while we're neutral on this count, we're seeing a very sharp spike in FY25. Sustainability of this is the question. It's a cyclical sector as well, but look, from the looks of it, it's looking far better than what the environment was maybe a couple of years back, and things have also started to improve for the company. We'll just talk a little bit about production as well, and that'll give us a sense on how return ratios will likely evolve. Shareholding pattern, 70% owned by the promoters, no concerns there. Public holds the balance, there's no institutional investor involved. And you look at the number of shareholders, fairly okay. We've been around the 18 to 22,000 mark in terms of number of shareholders. Valuations, it trades at a premium for sure. So it trades at 32 times trailing 12 months. The 5-year average has been 15 times, but of course, those times were different, especially in this factors in the 2 to 3 years during COVID as well, where there was sharp compression in terms of valuations. Now, of course, that has decompressed in a very sharp fashion. So covering both of those, let me in fact bring on board Mr. Mayank Agarwal, who's the CEO at Gallantt Ispat, to talk to us about what the journey looks like going forward. Mr. Agarwal, let me start off with the numbers that you've disclosed, right, on exchanges. And as a result of that, you're seeing the reaction on the stock as well. Talk to us about what this means. There's been a sharp ramp up, especially on your raw material side of things. What does it mean from EBITDA per ton stroke EBITDA margin perspective?
A very good afternoon to you, and thank you for having me here. In the last year, FY25, we had commissioned a lot of units such as pellet and some DRI units, which yielded results only, which was commissioned only in H2 of 25. So in 25, in 26, what we see here is a better realization in terms of backward integration, where power on a year-on-year basis has increased by 6%, which is the captive. The pellet has increased by 37%. So which means that the company need not buy from the market that much of raw material and can directly source iron ore fines and coal, which is the main raw material. Likewise, it's DRI, and even in the final product, that is TMT bars, we have seen a good increase in Q4 and an overall increase on year-on-year basis as 3%. So overall, the company has done good in terms of volume, year-on-year basis. And if we talk about EBITDA per ton, so all these integrations and all these cost reduction measures which were taken in 24 are yielding results in 25 currently. So that is why we see, despite reduction in realization, as you mentioned, we see better per ton margins at around 8,700 rupees in 9 months of the current year compared to last year.
Okay, I won't talk about Q4, and that's understandable, but give us a sense on FY27. What is in store over there? You're at 1 million tons in terms of capacity. Your capacity utilization is pretty much maxed out, if I understand it correctly, Mr. Agarwal. And now you're fully backward integrated. How much of the increased production on pellets, etc., accrues to you in FY27? What does it do to your EBITDA per ton?
So what is going to happen in FY27 is that currently we are in the process of adding certain quantities, where from currently 1 million, we would be achieving installed capacity of 1.24 million tons by H2, second half of the next financial year, 27. So automatically that will drive the front line in terms of revenue and volumes. And we are, as we have already commissioned all our backward integration beforehand, so we are well positioned to take advantage of the EBITDA margin that we currently carry. So overall, in the next financial year, while we increase the volumes, the EBITDAs or the cost reduction measures that had taken would yield results, and subject to realizations, which is difficult to predict. But in general, the company is very well positioned in for the FY27. Also, apart from capacity additions, currently we have a capex plan of about 3,000 crores. out of which some part is about 1,200 crores is going into the capacity addition, while 300 crores is also going into solar, which will also be commissioned in H2 of the 27. So that it would lead to further cost optimization from the input side in terms of cost of power. And post 27, we are also into capex mode for certain mines that we had purchased. So overall, in the next 3-4 years, the things are very streamlined from the company's perspective, and things are looking very wonderful, and we are really excited to take it forward.
Okay, you've given us so much data. Let me unpack it a little first. Your production capacity itself goes up by around 25% over the next 2 years is what you're saying. So FY28, you will see a 25% higher production capacity. I'm talking full year. FY27, you'll see a 12% increased production capacity. Right. So that's the right way to think of it. And in terms of how should one look at your raw material and your mines? All of your mines and your raw material ramps up at the same pace, or do you expect that to probably be slightly slower or grow with a lag versus the kind of growth you're seeing on the finished product side?
So the capacity expansion, which I mentioned by 25%. So for that, our intermediary products, which are billet, DRI, and pellet and power, are streamlined. Power is coming from solar, whereas DRI and pellet were already commissioned. So that those would lead to better capacity utilization in FY27. Apart from this, talking about mines, the company has still not started the operations of the mines. These mines were bought last year. For Gujarat unit, we have purchased it in Rajasthan. And for UP unit, we have purchased 2 iron ore mines last year in UP itself. So currently the capex is ongoing there in mines, and it would take about another 2 years for the mines to be operational. So the result is not going to be visible in FY27, but yes, 28, 29 for the mines.
Got it. And that is only for the incremental 25% capacity, right? The rest of it is well covered by you from a mine standpoint. Am I right?
No, there is a little bit of gap there. The mines are currently not operational. So currently the company is sourcing iron ore fines from the market. And once these mines are operational after 2 years, the company will be 100% integrated towards the back end in terms of iron ore mines.
Understood. How much does that add to your EBITDA per ton, sir? Give us a sense of that.
So, to assume the right number would be a bit difficult at this stage. But yes, based on what the business plan says and what the technology and everything is available, it will lead to very substantial increase in the EBITDA margins, very considerable increase, because currently the logistic part would be very well taken care of, especially in UP unit where the mines are located in UP itself. And even for Gujarat, the mines are located in Rajasthan, but the freight cost is not very high. So the mines would definitely add to the EBITDAs very, very substantially. And we are very excited on that front.
Got it. But that is FY29. Let me bring it back to slightly more near term. Your goal is to hit 5,000 crore in terms of top line. Do you do that FY27? Do you surpass that in FY27 itself?
So as we put the numbers into perspective just a while ago, so an increase of about 12% is what is expected in terms of volume the next year. So going by the current realization, it would easily surpass that number. However, it totally depends on the realization cost. But what is in our control is to reduce the cost of product. And we have been tirelessly working on that front in the last couple of years. And as explained by you a couple of minutes back, that is visible in the trajectory of the EBITDA improvement that we have witnessed. So what we have in hand is being done, and hopefully the market remains supportive.
Okay, point taken. With regard to the fresh capex that is coming on stream, some of that is obviously on the back of fresh mines that you're acquiring. Some of it is on the back of increased capacity. talk to us about how you're going to be funding that, because it's going to be a large capex which you're going to do.
So currently, the company is very well positioned in terms of cash flow, as currently we don't have any long-term term loans at all on the company. It's only working capital. And as you had mentioned a while back, there were some short-term borrowings which are broadly all paid off in the quarter. So the entire accrual of the company will be utilized towards all these expansions. And we do not see any gaps in the same. So even without the loans, without the term loans, we would probably be able to manage all our capex of 3,000 crores in the next 2 years, 3 years, provided the market is supportive.
Understood. Would the return ratios only tilt upwards, therefore? Because I know there is fresh capex coming in, but it's going to be gradual fresh capex, is what I'm understanding from you. And therefore, return ratios is largely expected to be at 15% plus. Is that something we can very comfortably say?
Yeah, I mean, that much should not be a problem. And I would like to give your viewers a little bit of breakdown into capex to understand the company better. So out of the 3,000 crores capex, 1,200 crore capex is going for capacity enhancements in various units, wherein steel making capacity shall be enhanced, as I told you, up to 12.25, and along with all the intermediaries already backed up or under expansion. Out of this, approximately 500 crores capex, more than 500 is already done in the current last FY, 26. And certain units have already commenced production in the current year, FY 26, last year. And balance will be completed, as I told you, in Q3, 27 itself. So this 1,200 capex will be done in the current FY 27, and we would see partial results as discussed. Apart from this, there's about 1,500 crores of capex in all the mining projects, which includes beneficiation and a pelletization unit at Rajasthan. So the mines that we have bagged would provide us a raw material security of about 20 years, including for this complete 1.25 million tons post-expansion. And this 1,500 crores would take another 2 years. So 29 onwards, we see the results. Apart from this, there's about 300 crores in solar, where we are installing a total of 78 megawatt of solar for our captive requirement. This will also progressively be commissioned in 27 itself. Some unit, about 18 megawatt, would be available to us in Q3, and the rest in Q4 expectedly. So I mean, while most of half of the capex would be done in 27, half of the capex would be in fact completed in 27, and the mining would only be the balance part, which would go on in 28. So whatever the capex is happening in 27 will see some bit of results in 27 and complete results in 28 by the time the mines also kicks in.
Explained it beautifully. I mean, if someone hasn't understood it, has to just scroll back and listen to that piece. Okay, and with regard to, just give us a sense on two pieces now. One, what's the downside risk with regard to realizations? Give us a sense of that. I know it's not in your control, but you have enough of a pulse on it. So give us what's playing out. And second, with regard to West Asia, what's the impact on you?
So currently, because of the war scenario, definitely the input costs have gone up because of the energy sector and the metal sector prices going up. It will also impact the project cost if the war continues for a longer time. And but currently, whatever the cost implications have been there is being transferred in the pricings, and the market is currently supportive of it. However, going forward, we have to wait and watch. If the war continues for a long time, the economy in general would be negatively affected, and steel will not be a product which will be away from it. But in general, if we talk about the growth story of India and the kind of infrastructural development and the spending happening in India, taking into perspective the steel, which is construction steel that we deal with, which is broadly dependent on the construction industry, whether it be real estate or infrastructure. So overall, currently, Indian economy seems to be in a very robust condition on a long-term perspective. And in a long-term perspective, we expect good realizations and good demand scenario going forward.
Okay. Mr. Agarwal, thank you so much for joining us. This has been really comprehensive, and you've been very candid as well. So thank you for that. Viewers, that's all the time I have on this edition of All About Your Company. Thanks for tuning in. More action on the other side. Stay with us here on ET Now.